Have you tried thousands of indicators and strategies since you started trading, but still find yourself struggling to be profitable? Or maybe you're eager to discover the best strategy for trading. In this video, I'll share 3 powerful trading strategies with winning rates of over 90%. Let's dive right in.
I don't ever slow up, no I don't take shit. I got no love for the fakeness. If you wanna play tough.
Simple moving average strategies. Let's begin by discussing how to set up this indicator for maximum results. Start by clicking the indicator button in Trading View and searching for Moving Average ribbon. Once you've added it to your chart, open the settings and adjust the values. If your values don't match these, make sure to update them accordingly. Don't forget to set the colors as shown here. These shading colors make it easier to analyze the chart at a glance. With the setup complete, let's dive into the strategy. Number 1. Finding explosive movements. To identify explosive price movements in the market, focus on how the simple moving average lines align. When the 100, 50, and 20 lines are systematically positioned below the 200 line in the correct descending order, it creates a clear signal for a potential downward breakout. This structured arrangement signifies growing bearish momentum, indicating that sellers are taking control of the market and pushing prices lower. Conversely, an upward breakout is signaled when the SMAs are aligned above the 200 line in the opposite order, highlighting a build-up in bullish momentum as buyers dominate. Through backtesting across multiple timeframes, this strategy has shown an accuracy rate of 95% on timeframes above 15-minute. Number 2. Angle of 200 simple moving average line. Trends in the market can be significantly refined by observing the angle or gradient of the 200 line. Think of this line as a thermometer gauging the health of the trend. A positive angle often signals an uptrend, meaning the market is bullish, while a negative angle suggests the opposite, indicating a bearish market condition. The steepness of the 200 line's gradient adds an extra layer of insight. A sharper angle, whether positive or negative, reflects stronger momentum and a clearer trend direction. For instance, a steep upward slope often coincides with strong buying activity, while a steep downward slope points to intensified selling pressure. Number 3. Modify Golden and Death Cross. The Golden and Death Cross strategies are classic and widely used. A golden cross occurs when the 100 moving average crosses above the 200 moving average, suggesting an upward price movement. Conversely, a death cross happens when the 100 moving average crosses below the 200 moving average, indicating a potential price decline. While simple, these crosses gain better accuracy when you incorporate the 200 lines angle. For example, if a golden cross forms while the 200 line has a positive angle, it's a strong signal for an upward trend. However, if the 200 line has a negative angle during the golden cross, it weakens the signal. Similarly, a death cross combined with a negative angle of the 200 line is highly reliable, while a positive angle diminishes its strength. By integrating these nuances, you enhance this strategy's effectiveness. Second strategy, RSI Indicator. Begin by selecting it under Indicators in Trading View and checking the settings to ensure everything aligns with the strategy we'll discuss. Number 1. Divergence. Many beginners use the RSI to identify overbought or oversold conditions. When the RSI dips below 30, traders often assume the asset is oversold and bound for an upward reversal. Similarly, when it rises above 70, they expect the price to reverse downward. However, the RSI can linger in these zones without signaling an actual reversal. So, how can we use it effectively? The key is divergence. For example, if the price makes a higher high while the RSI makes a lower high, it indicates weakening bullish momentum or bearish divergence. On the flip side, if the price makes a lower low while the RSI forms a higher low, it signals weakening bearish momentum or bullish divergence. These divergences can be used to anticipate price reversals with over 95% accuracy. Number 2. Avoiding bull and bear traps. The RSI also helps avoid traps. Imagine the price making a higher low during a downtrend. Many traders might see this as a sign of a bullish reversal. However, if the RSI forms a lower low instead, it indicates continued selling pressure, suggesting further downward movement. Likewise, in an uptrend, a lower high in price alongside a higher high in the RSI signals persistent buying pressure. Third strategy: identifying pullbacks. Imagine running a long distance without a break. It's exhausting, right? Similarly, asset prices also need to pause during extended trends. These pauses, or pullbacks, are key opportunities for traders. Identifying the end point of a pullback. Number 1. Fibonacci retracement. To identify when a pullback ends, consider using the Fibonacci retracement tool. The 0.618 level, known as the golden pocket, is a popular area where trends often resume. Number 2. SMA lines are support or resistance. Additionally, watch for support or resistance forming along SMA lines, as this can indicate a likely continuation. Number 3. RSI for momentum loss. You can also combine pullback analysis with the RSI to detect when an asset is losing momentum, much like we did earlier. Number 4. Chart patterns. Chart patterns like wedges, flags, and triangles are also useful. A breakout from these often signals the end of a pullback. Number 5. Candlestick patterns. Lastly, candlestick patterns like engulfing candles or morning stars can provide strong signals for entry points. By mastering these techniques, you'll be able to identify high-quality trades with confidence.